The bear is back. Not for stocks, but for oil prices. Domestic crude broke below $40 a barrel midday to settle down more than 20% from its most recent high in June. That technically qualifies as a bear market. Now, a number of factors are contributing to the slide. On the supply side, there are early signs that production is increasing in the U.S., just as output from OPEC and elsewhere is rising. And demand isn't increasing enough to mop up the excess. As a result, crude settled down nearly 4% today to about $40 a barrel. Hello, Mr. Bear. And as the oil price tumbles, gas prices follow. Jackie DeAngelis has a look at what drivers can expect when they go to fill up.
Good news for consumers. Gas prices are falling sharply at a time that they're expected to rise. According to AAA, the national average for a gallon of regular gas is $2.13. It was $2.66 last year, and that's the average. Some cities are well under $2, which is unusual for the height of the summer. Causing the decline, a glut in relatively cheap oil. That led to a refining boom, and that created a gasoline glut. Seasonally, summer is when Americans hit the road, so it's one time of year that we can expect an uptick in demand. That demand was robust, but not enough to make a dent in inventories.
We started out the driving season with, needless to say, an abundance of crude oil. That crude oil had to be used. It was refined into gasoline. Refineries were running about 92 to 95%, which is about 4 to 5 percentage points higher than previous years.
So what happens after the summer? When demand drops off and we see crude and gas prices decline every year, those drops will be even more pronounced.
As the price of crude oil slides, you're going to see a slide in gasoline prices. Number one, we switch over to the October contract, which is the winter grade, and we lose 10 cents a gallon just by switching it over there. Demand usually drops in the late third, fourth quarter, and first quarters of every year. So I would expect gas prices to touch maybe the 150 area by Christmas or even New Year's.
Meantime, Barclays is out with a negative note this morning saying the drain is clogged and also pointing to oversupply issues and demand issues internationally come this fall. The Saudis continue to pump oil to compete with Iran, so there's little relief in sight. The only caveat that could shift this story from fundamentals and send prices higher is the dollar, which typically moves on Fed expectations. If the market feels the Fed won't hike, that means a weaker dollar and higher crude prices. But for now, consumers are relishing in less pain at the pump. For Nightly Business Report, I'm Jackie DeAngelis.